Hello and welcome. So today's video is going to be a stock review of Owl Rock Capital Corporation, ticker symbol ORCC. We're going to take a look at the balance sheet. We're going to take a look at the income statement. I'm going to take you through the latest investor presentation. And at the end of the video, I'm going to give you multiple different forecast possibilities so you can see what the realistic outcome is over the next 2 and 4 years for this particular stock if you were to invest in it. And I'll of course let you know if I've been investing in this stock, if I intend to invest in this stock, and at what price. If you're new to the channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving, or investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you get notified every time I release a new video. And if you enjoy this video and find it useful, please do remember to give it a thumbs up, because that helps YouTube algorithm, which in turn helps me, and I do appreciate it. So first things first, Owl Rock Capital Corporation. It's a business development company. If you've watched my videos in the past, you'll know all about business development companies. If you haven't watched my videos in the past, where have you been? But basically a business development company is a company that lends to middle-sized businesses that are too big to borrow from the bank but too small really to float on the market and raise capital that way. So that's essentially what it does in a very quick nutshell. You will have seen, if you've watched my videos in the past, you will have seen me talk about Owl Rock Capital before in 2 videos. My most recent video where it was compared against 5 business development companies, so it was one of 5 that we did a comparison of, like a 5-way head-to-head if you like. I'll put a link up there to that video and the description down below if you're interested to see how it compared to those other business development companies. And you will have also seen it in the head-to-head video, which was a versus video that I did, where we did Main Street Capital versus Owl Rock Capital, and that was a straight head-to-head, and obviously I went into more depth on both of the companies there. In today's video, I'm going to go into even more depth on Owl Rock Capital. Obviously, if you're interested in that past video, again, I'll put a link up there and in the description down below, so you're welcome to check that out as well. Now, one of the key things to be aware of with business development companies is that they have to pay out 90% of their profits as dividends, okay? So they're a high yield stock, which makes them ideal for people who want to retire or people who want a high dividend yield on their investments, which is obviously one of the things I'm looking for. I'm actually looking for to build at the moment. I'm looking to build a high yield dividend portfolio, so that's why I'm considering this kind of stock. If you have any ideas or suggestions of such stocks that are high yield with the potential of some upside as well on the capital, then please do let me know in the comments down below. I'd be very interested to hear. I get some of my best suggestions from the comments in this channel, so please do feel free to leave your comments. I do read every comment and I try to reply to all of them where I can. Okay, so with all that said, let's just jump straight in and take a little look. We're going to look straight at the investor presentation. This is the latest investor presentation from May for Owl Rock Capital. So here is the Owl Rock Capital May 2021 investor presentation. So quickly here you can see, I'm going to swing through these slides nice and fast for you. Basically, the key point to pick up here is it's the second largest publicly traded business development company following its IPO in July 2019. This slide shows you a breakdown of the platforms, so you can see the different sectors, and you can see it was a merger of multiple different business development companies which essentially created Owl Rock Capital Corporation. So this slide shows you the market cap, 5.4 billion. You can see the portfolio size is 11.2 billion, and there's 120 companies in the portfolio spread over 29 different industries, and we'll look more into that in a moment. The key things I want to pick out on here is basically the average loan to value of 45% across the portfolio, and the fact that they have a conservative balance sheet with 3.5 billion of unsecured debt. 62% of funded debt capital is unsecured debt. 4 investment grade ratings which remain unchanged. We'll look more at those in a moment. And they have significant liquidity with 2.5 billion of cash and undrawn debt capacity. This slide here shows you the net asset value per share is currently 14.82 cents, so $14.82, which is up from $14.74 in December 2020. Now that's a key point there. Please remember that number. We'll be coming back to that later. The net investment income per share, however, notice that fell to 26 cents, and that's in a quarter, down from 29 cents, which was in the last quarter of 2020. The net income per share of 40 cents is down from 46 cents in the last quarter of 2020. So again, it has been down in this first quarter of 2021. The dividend per share was 31 cents and the dividend yield was 8.4%. The key section I want to point out on this slide here is the history of avoiding challenging sectors. So it's avoiding energy, casual dining, medical practice roll-ups and retail, for example, and concentration risk customer end markets. So it's basically they're trying to mitigate the risk. And the other key thing to point out on here is they are much more interested in first Lewin focus rather than investing in second Lien debt. And when they do that, they only invest in high quality, most resilient companies. Now, if you don't know what that means, first Lien lending basically means they've got the first charge. So if you think of a hierarchy of lenders, you've got a borrowing on an asset, they will get paid out first. So the first Lien, if you like, gets paid first, then the second Lien, then the third Lien. You'll also hear it called senior. So the senior charge would get first and the junior charges would get second. And actually the shareholders generally get paid last is how it works when paying out debts for things like that. So the fact they're taking first Lien is a reassuring thing. Our approach to building the portfolio focus on upper middle market companies with stable recession-resistant business models and a low loan-to-value ratio. Now that's important again because if they're taking the first Lien charge, if they've got a low loan-to-value, so the asset that they're lending against, they've got a small loan to value of, that means if that asset was liquidated, they are much more likely to get paid out. Speaking of which, they've only once, if you see here, had one loss of principal, which represented an annual loss of less than 11 BPS, and that is basis points. And if you don't know what a basis point is, a basis point is 1/100th of a percent. So we're talking about literally 0.1% here that they lost on that particular deal. So it wasn't like catastrophic in any magnitude at all. So what they're pointing out there is, yes, they've had one go wrong in all the time they've been doing this, and the one that went wrong, that was basically what their loss was. So it's not exactly a bad thing. Obviously it's not a good thing either that they had a loss, but the point is when they did have a loss, it didn't affect the business. Here you can see a breakdown of the industries on the right, so you can see it's quite diversified. You've got internet software services taking up the biggest section, which is 10%, insurance takes up 8%, food and beverage taking up 8%, and so on down that list on the right hand side there. And then on the left hand side graph you can see that 94% are senior secured investments, and you can see 77.8% are first Lien debt investments, meaning they've got the first charge. Then there's a 16% which is second Lien debt investments, which means they've got the second charge. So there is someone else has the first Lien or the first charge above them, if you like. And then you can see the smallest chunks as well. So you can see in 3.5% of cases they've actually taken an equity stake in the company as well. The key thing to look at on this graph here really is the growth. So you can see Q4 2020 was obviously substantially higher than the previous 4 quarters, which you would expect. And it's nice to see that first quarter of 2021 has beaten the first quarter of 2020. So that's a nice sign of growth. Here you can see the historical internal investment ratings. So this is how they've rated their investments. So you can see in Q2 2020, they had 9% of borrowers were performing better than expectations, and you can see how that's gradually improved so that now it's 12%. You can see that it stayed fairly consistent on the ones performing as expected, but you can see also that the ones that are underperforming, that number has reduced. So again, that's a good sign. This slide really just emphasizes the fact they've managed to maintain really good credit ratings, which on a company that makes its money from borrowing and lending is very important, that it has a good credit rating. And that's what this slide shows. With all 4 of the credit rating agencies, it has an excellent credit score. Diverse access to financings with a well-laddered maturity, and it's that ladder on the right hand side that I'm particularly interested in. As you can see, there's no debt due in 2021, there's no debt due to be repaid in 2022, and the bulk of it is 2026 and beyond. And as you can see at the bottom there, it says 2.5 billion of liquidity in cash and undrawn debt as of March 31st, 2021, with no debt maturities until June 2023. So that's 2 years away before they've got to pay back any of the money that they've borrowed. Because essentially what they do is they borrow at one rate and then they lend out at a higher rate, and that's how they make their profit, is the difference on those rates, which is why it's so important that they have a high credit score, which obviously we've demonstrated they do. This is a very interesting slide. If you look at that top row there, the net investment income per share, you can actually see that's been falling. From Q1 it was 37 cents, Q2 in 2020 34 cents, Q3 in 2020 33 cents, all the way down until it got to 26 cents per share in Q1 2021. So that, I would say, is bad. Okay, quite simply bad. We don't want to see it shrinking. We want to see that growing, not shrinking. Next, if you look at the row below that, you can see net realized and unrealized gains or losses per share. Here, this paints a slightly different picture. You can see Q1 2020 was very bad. That was a loss. If it's in brackets, that means it's a loss, basically. So that's essentially minus $1.17 per share. Q2, 45 cents profit, much better. Q3, 23 cents profit, which is down, obviously. Q4, 17 cents profit. What's good to see is that in Q1 2020, it's made a profit profit, albeit lower than the previous 3 quarters, but at least it was a profit versus loss in the first quarter of the previous month. And then if we look at the next row, that shows you the net income per share, which is a critical figure because it's out of that the dividends can be paid, because this is the profit. It had a loss in Q1 of 2020. It made a profit, which wiped out the loss in Q2 of 2020. Another profit, but shrinking, 56 cents. Another profit, but smaller again, 46 cents in Q4. And another profit, but smaller again in Q1 of 2021. And you can see the dividend has stayed fairly stable at 31 cents per share per quarter. Now, key thing I want to point out there, this I see is the weakness of the company. The fact that income has been falling, we're hoping that that's going to turn around. If you're going to invest in the company, you need that to be turning around. So we'll be looking in the next few quarters. If you're watching this stock, you want really to see those figures pick up. You don't want them to continue down, because obviously if they continue down, there's a serious risk that they'll have to cut the dividend, which is not something you want to see. We're going to talk a little bit more about the dividends in a moment. So here we are, dividends, estimated dividend yield, and you can see what dividend they were paying. So in Q3 of 2019, they paid a 31-cent regular dividend plus a 2-cent special dividend. Q4, another 31-cent regular dividend and a 4-cent special dividend. Q1 of 2020, 31-cent regular dividend and an 8-cent special dividend. They did the same in Q2 of 2020, same in Q3 of 2020, same in Q4 of 2020. However, if you look in Q1 of 2021, they cut the special dividend, so they're not doing the special dividend, they've just maintained the regular dividend. And in Q2, they've maintained the same. And obviously the ticks mean it's been approved by the directors. When I do my forecast later, I'll forecast it both ways. One will be assuming that it's just the regular dividend, and the other will be assuming that the special dividend is reintroduced. Now, bear in mind that they have to pay out 90% of their profits. So if they are making more profits than the 31 cents, and if that 31 cents is less than 90% of their profits, they must pay that out, which is why they will have special dividends. It's very common for business development companies to have special dividends. The way this company does it, I think, is quite nice, adding it on at the same time as they do their normal dividends. And then what differentiates Owl Rock? They've listed a few points here. Diversified portfolio designed for a large institutional investor base focused on quality and consistency. If you look down a little bit further, it says disciplined, risk adverse investment style, and as you can see at the very bottom there, delivered a stable and attractive dividend. So these are key important things to them, and it's purpose built to be a leading high quality institutional business development company. So before we go and look at my forecasts and see what share price I think it's worth buying at, if I think it's worth buying at all, and what my forecasts are, let's first take a quick look at the income statement and the balance sheet. So here's the income statement for Owl Rock Capital here, and you can see the gross profit has been steadily increasing, which is very good to see. Even the trailing 12 months, you can see there, is higher than it was in December 2020, and 2020 was higher than it was in 2019, and so on. In fact, it has had what I can only be described as phenomenal growth, quite honestly. If you look at the operating income a little bit lower down there, you can see a very similar picture. There has been a slight drop off in the trailing 12 months, which is probably why the special dividends were suspended for now, and they're not been issuing the special dividends essentially. They've just been doing the regular dividends because of that slight drop, and they want to conserve some cash, which is fair enough. And if you look at the net income, which is essentially the profit, look at that growth there. Bear in mind this is in millions. So you've gone from 20 all the way up to 850. Wow, that is some serious growth there in the space of 4 years. So part of that will be from the mergers and whatnot, but still that is frankly phenomenal. You can see the revenue per share there as well. So you can see it was $1.62 in 2016, climbed to $2.38 in 2017, climbed again to $2.66 in 2018, it fell in 2019, $2.21, fell again in 2020 to $2.07, but in the current trailing 12 months, it's actually increased to $2.11. So now let's look at the balance sheet. So the key things I like to look at on the balance sheet really for a business development company are the total assets versus total liabilities. So you can see the total assets there were climbing and have climbed rapidly. They're literally 10 times as big in the trailing 12 months as they were back in 2016. Literally, it went from 1180 to 11,500 actually, which is, and these, so that's 11.5 billion. So you've gone from 1 billion to 11.5 billion in the space of 5 years, which is phenomenal growth. The total liabilities have also increased tenfold as well, going from literally 500 million to 5.7 billion. But still, I would say that's a good ratio. And if we go down here, we can see the total equity, which is a stockholder's equity. And you can see that that has also increased almost tenfold, from 680 million to 5.8 billion in the same time frame. Another interesting metric to look at there would be the book value per share. So you notice in 2016 it was $14.85 per share. That increased to $15.03 per share in 2017. Increased again in 2018 to $15.10 per share, increased again in 2019 to $15.24 per share. We had a fall in 2020, as did everything, because the assets would fall. Bear in mind, this is invested in companies, so if the assets, the value of those companies fall, so does its net asset value. So quite obviously, if there was a crash in prices, which we saw a crash in the stock market, obviously a crash would devalue any company. If this is invested in companies, the companies are devalued, therefore their book price or their net asset value also goes down. So as you can see there, that went down to $14.74, and it's increased again to $14.82 in the most recent 2021 report. So next we're going to take a look at my spreadsheets. I'm going to show you my forecast, but before I do, I just want to show you the assets versus liabilities. If you watched my previous video, you will have already seen this, because this was actually something I included in the 5-way head-to-head that I mentioned earlier. So total assets versus total liabilities, you can see what the total assets were on the top line there, you can see what the total liabilities were, and then you can see how they compare. And it's a 2.0 ratio, which is excellent, by the way. That is absolutely excellent. What that means is they've got much more, they've got more than twice as many assets if they've got liabilities, basically. Well, in fact, in this case, exactly twice as many assets as they've got liabilities. So if they were to sell everything up, they could pay off all of the debts that they have and then have all that money left over again, basically. And then the current assets versus the current liabilities, it's got a 1.46 ratio. Again, what you're looking for there is a number bigger than 1, because the current assets versus current liabilities is the assets and liabilities coming due in the next 12 months. So the borrowing coming due versus the things coming in, if the money owed in the next 12 months, if you like. That's what that is. And that basically, you need that number to be bigger than 1. If that number's smaller than 1, that's where potentially a company can get into trouble. And I tend to avoid companies, quite honestly, if the number's smaller than 1. If the number's bigger than 1, everything's great in the world. And here you see everything's great in the world. We're looking at 1.46, so everything's good. Let's have a look at my buy prices here. So you've got a current market price of $14.32, and this is obviously going to be fluctuating all the time. It's what it was when I made this slide. My target buy price is actually higher than that, $14.59. I think anything up to $14.59 represents good value. So yes, I am buying these shares, and yes, I have bought shares on this. And in fact, I bought them for $14.59. It was slightly higher than that when I put my order in. And actually, I bought it for slightly less than that. I'm saying I bought it for $14.59. I actually bought it for $14.55. But my maximum I would pay would be $14.59 at this point in time on this stock. But my ideal buy price would be $13.78. So given those three figures, let's look up the forecast. I'm going to give you two different options on the forecast for each of those buy prices. One is going to show you if they keep their dividend the same, how the money will perform. And the other will show you if they reintroduce their special dividend at 8 cents per dividend, how the money will perform, so that you can see what you would get back if you used to invest money. And for simplicity's, I'm just assuming $10,000, but obviously the percentages remain the same. So let's take a look at my slides now. So at the current share price of $14.32, if you were to buy $10,000 worth, you would get an annual dividend of $865.92. Now this is assuming that the dividend stays the same as it is at the moment and stays that same amount, and there's no special dividends at all between now and 2025, which by the way is very unlikely. Okay, my view is that there are going to be special dividends, so the slides I'm about to show you later I think are more probable to happen than this outcome. So this is your ultra conservative outcome, if you like. And as you can see, by 2023 I'm forecasting the share price will be $15.40, and by 2025 I'm forecasting the share price will be $17.20. And just briefly, let's take a look at the share prices so you can see how realistic I'm being there. So here is the chart showing the current share price. So you can see the current share price right now is $14.26, so slightly lower than it was when I made the slide, so even better value. And you can see prior to the big crash in March 2020 where everything went down, the company was trading around the $15.50 mark. So what I'm saying is within 2 years, I expect it to get back to that price. And I'm being conservative there. It'll probably do that quicker. As you can see, this line here is increasing. So there's a very good chance it will get there sooner, but I'm being conservative and saying within 2 years, we'll be back at this kind of level that you saw here. Now, what I'm then saying is that in 4 years' time, we're going to be back up to the level you see around here, which is the higher level, which is not quite its peak. It peaked at 1860, so I'm pulling back more than $1 per share from its peak, but I think this is realistic in 4 years' time, and it may well be higher than that. So I'm attempting to be conservative, but that just gives you a look so you can see how the share price is looking. So assuming it does get to $15.40 by 2023, that will give a 7.54% gain on capital, plus you will have earned 17.32% in income from dividends, which makes an average of 12.43% return per year, which obviously beats any bank. Then by 2025, at this same level, you're looking at a 20.01% gain on capital plus a 34.64% return on dividends, makes an average of 13.66% per year total return. So if you were to buy at the target price, so if you're watching this video a little bit later and the price has gone up, you might find that this target price is still applicable. Okay, and if still this price or less, this will give you an idea of how much you could stand to make, assuming again that the dividends stay the same and the special dividends are not reintroduced. I'm going to show you what will happen if the special dividends are reintroduced in a moment. So assuming they stay the same, here we go. So if you was to buy at $14.59 per share, you would make $849.90 in dividends. This is assuming you bought $10,000 worth. By 2023, you would have capital worth $10,555.17, which is a gain of 5.5%. You would have made $1,699.79 in dividends, which is basically 17% on earned income there, which makes an average of 11.28% return per year, which is not as good as buying at the current share price, but it's still a decent return. If you wait until 2025, you would have a 17.89% gain on capital plus 34% in dividends earned in income, which makes an average of 12.97% per year total return. Now, what happens if you buy at my ideal target price? So in the event that the share price drops to $13.78 or below, and it has done that literally just 4 weeks ago, it was at this price, and it was at this price for quite a long time before that. So this is not an impossible thing, okay? So if you wanted to add this to your watch list and set yourself up a notification with your broker so that when it goes under $13.78, you know you want to buy it, then by all means you could do that, couldn't you? I should just say at this point, I am not a financial advisor, so this is not financial advice. You need to do your own research and due diligence before investing in any stocks and shares. But these are numbers I've worked out, so let me go through them with you now. Assuming you bought $10,000 worth at $13.78 per share, you would get $899.85 in dividends per year, and this is assuming the special dividend is not reintroduced, which by 2023 you would have made an 11.75% gain on capital plus 18% total in earned income, which would make an average of 14.88% per year total return, which is obviously pretty good. By 2025 you would have 24.82% gain on capital, so you would have made nearly an extra quarter just in capital, plus you'd have 35% or 35.99% dividends earned in income. So essentially you'd be over 50% up at that point, but on average that makes 15.2% per year total return, and that's assuming you don't reinvest it. So now let's look what will happen if the special dividend is reintroduced. If the special dividend is reintroduced and reintroduced at the 8 cents rate, that's 8 cents extra per quarter, here are the figures. Now, assuming you bought at $14.32, which is our current buy price, you'd be getting $1,089.39 per share, which is essentially a 10% yield, so that's awesome for starters. You would make 7.54% gain on capital plus 21.79% by 2023, which makes an average of 14.67% per year return. By 2025, you'd have a 20% gain on capital plus a 43.57% income from the dividends, which would give you 15.9% per year total return. Now, for those of you watching this later when the price has gone up, if you were to watch it and the price is up at $14.59, so higher than it is now, but this price was the price yesterday, quite honestly, then you would be looking at still over 10% return, because you'd be getting, for your $10,000, you'd be getting $1,069.23 per year in dividends. Your capital gain by 2023 would be 5.55%, plus you would have had 21.38% in dividends earned by that point, which would make an average annual return of 13.47% per year. By 2025, you could realistically, I believe, expect to return 17.89% in capital gain plus 42.77% in dividends earned, which would make you an average of 16.42% per year total return. So even at that higher price, it's still a reasonably good investment in my opinion. And also remember that higher price is lower than the book value. And it's very rare to find a company that trades lower than the book value. So essentially, you'd still be buying lower than the book value. If the book value goes up, the share price is likely to go up as well. And usually with business development companies, the share price usually sits slightly above the book value. So it's when you're buying it below the book value like this, you're actually buying it at a discount. So that means there's a blooming good chance that your capital is going to go up. Now, I'm not saying it's going to go up massively. We're not talking about an Amazon or an Alibaba or a Facebook or a share that's going to rocket at all. That's not what I'm saying here. But you are managing to buy it below a discount, below its market value, essentially. And that, I think, is important, especially when buying these kind of shares. If you're able to do that, that's when you should. And that's why, even though the price I'm showing here is higher than the current market price, I'm saying actually it's fine. Up to that price, I would be happy to buy. And obviously I did, and I will buy more as it goes down, and we'll go through that in a moment. But let's carry on with this. If it comes to the ideal price of $13.78 per share, this is where I would be loading the boat myself. This is where I'd be really trying to get some in, because then over the first year even, you'd be getting 11% in dividends, essentially. So by 2023, you would have a capital gain of 11.76%, and you would have an income from dividends of 22.64%, which makes an average annual return of 17.2%, which as a passive return, I think you've got to agree is really good. Now by 2025, you're going to be looking at a 24.82% gain on capital, plus you've had 45.28% of your initial investment back in dividends, and that makes you an average of 17.5% per year in total returns. So again, I think it's a good investment. I think it's one whereby there's not much money going to be lost in this investment. It's not one that's going to be particularly exciting. For me, it's more like one to use as a kind of like a bank account, a high interest bank account where I know I'm not going to need to make a withdrawal for at least a few years' time. Because bear in mind, the price will fluctuate. As you see, the price yesterday was higher than the price today. It may well be in a week or so's time, the price goes down and it actually hits this ideal price of $13.78. If it does, obviously that's a great time to buy. If you see this share dipping below 14 cents, essentially, it's a good time to buy. But ultimately, my view at least is in the next couple of years, we'll be going above the $15 per share, and certainly in 4 years' time, we're looking above the $17 per share mark. So your capital, in my opinion, should be fairly safe there. The company is big. It's the second biggest business development company available to invest in anyway, and it has seen phenomenal growth. If you watch my previous video, the one I did most recently, you'll actually see how its growth compared to other business development companies in the sector. I showed you graphs where you could see, and it was amazing, quite frankly. Anyway, thank you so much for watching. I hope you found that helpful. Have a nice day, and bye-bye.